You're using MTN, right?
Yes, I am, my brother.
It's just been off and on since morning.
Yep.
I just have to switch over to it.
All right, I believe my screen is up now. We'll be discussing open interest today. And I believe we clearly stated in our Telegram group, that's the Telegram group there, SimplyPips, simply_pips, that this is not for newbies. If you're a newbie and you just want to be here, just listen. Whatever strategy you are with now, please stay put with it. Let's learn not to jump from one thing to the other. I don't use 100% everything I teach on SimplyPips YouTube. I might use some of them, but sometimes we have to teach something because people seem to be asking lots of questions about them. So we just teach them. Doesn't mean I use it 100% of the time, right? So let's stay focused. Sometimes in trading, the less you know, the better it could be, especially if you are somebody who finds it difficult to put things together and make them, get a form of sandwich of information. You can reach us if you want to send a mail to pipsloveme@gmail.com. And please, if you haven't subscribed to the YouTube channel, you could do that. Right, so today we'll be discussing open interest. Forgive the error in spelling there, that is money, not Mori. Right, so open interest measures the flow of money into a futures market. Basically, that's what it does. It measures the flow of money into a futures market. And by that, we mean it could be currencies, it could be anything. It just measures the flow of money. Volume, some people confuse open interest with volume. Volume measures the intensity behind a trend, right? Whereas open interest is used to measure the strength of price movement, and it's also used to track the footprint of large traders. And when we say we are institutional traders, we try, even though we are retail traders, what we try to do is give ourselves this, permit me to use false feeling like we can actually read what the big banks are doing, and we're trying to flow along with them, right? So when we say institutional order flow, which is what we trade basically at SimplyPips, we try to trade in line with the banks, which we call institutional order flow. One way we can do this also is to use that term open interest. Now, if you've been following us for a while, we stated clearly that every strategy is hovered around a story, right? It's made up of a story. And that is why in SimplyPips, we don't condemn whether you're a naked chart trader or you're a clothed chart trader and use indicator. If it works for you and you're able to win consistently, may the markets bless our accounts, right? So open interest is used to track the footprint of large traders, and it's used to measure the strength of price move. And what is open interest? Right? How do we count open interest? Usually when we trade, depending on the theory, some theories say supply and demand. Depending on the theory, some use support and resistance, some use trend lines, channels, order blocks, breakers, sources, whatever it is, we try to predict what price will do next. And sometimes we try to predict how far price would go. But when you are trading using the open interest, you traditionally do not believe in this buyers and sellers model, right? And I'll quickly explain that before we move on to the slide, right? So traditionally, let me use a whiteboard, right? Just a minute. If I should ask us here that when price is making higher highs, who is winning? Buyers or sellers? I'll take this to be a rhetoric question because I've done this several times and I can tell you that most people will say buyers are winning, right? So if your theory is such that you see price movement as a battle between buyers and sellers, then you will say buyers are winning, right? So I can rephrase this question like this. And usually when I ask people that when price is pushing up, who is more in the market? Do we have more buyers or more sellers? And people will tell you that we have more buyers in the market, and that is why price is going up. From the principle of open interest, that answer is wrong. In fact, the question itself is wrong. Open interest states that there are equal number of buyers and sellers in the market at every point in time. So for the accountants, for every debit, there'll be a corresponding credit. Open interest says that there are equal number of buyers and sellers in the market. So what makes a trend to continue is the aggressiveness of the buyers, not necessarily because there are more buyers. And look at it. Let's look at it simple, plain terms. A transaction is not completed until a buyer is paired with a seller. So if you want to buy gold at $2,000, you have to pair somebody who has gold with somebody who has $2,000, right? If you pick a currency pair, let's say GU, and you are buying, it means that you are buying GBP and you are selling USD. What this means in the inverse side is that there is somebody who is selling GBP to you and buying USD from you, right? You can't sell to the cloud. It has to be an exchange. So you are buying GBP from somebody and selling USD to the person. So to that person, so A is buying GBP and selling USD. B is selling GBP and buying USD. Just the opposite. Same thing happens when you want to close a trade. If you go into a trade, sorry, somebody's having dinner there, so let's keep that secret. So if you go into a trade and you are long on GU, and for one reason or the other, price seems to be coming down, and you place your stop here. When price hits your stop, what happened is that you sold GU at that point. You remember your initial trade was a buy. When it gets to your stop loss, what happened is that you reversed what you did. You sold GU to get out of the trade, right? Same thing happens if you were buying GU and it gets to your TP. What happened is that you initiated a buy from your entry here. When it gets to your take profit, what happens is that you now initiate a sell, an inverse of that particular initial trade to get out, right? So at every point in time, there has to be a buyer and a seller in the market. You can't sell to yourself and you can't buy from yourself. So if you enter a buy, it's because there is somebody at the other side of the globe that is selling to you, right? Now, when one buyer comes in contact with one seller, and when I use one, I'm talking about the unit of measurement of that particular commodity. It could be gold, it could be currencies, it could be whatever futures it could be. When one buyer come in contact or come into an agreement with one seller, we say we have one open interest. So when one buyer comes in contact with one seller, comes into an agreement, a transactional agreement with one seller, we say that the open interest has increased by one. The open interest has increased by one when a buyer meets with a seller. So going back to that question, that when we have an uptrend, do we have more buyers or more sellers? We said, based on open interest, the correct answer is that we have aggressive buyers. And I'll use this common example. Say we have Mr. A, and Mr. A works in an organization and he's been given 10,000 US dollars, and the boss tells him to go buy, let's say, oranges, right? And the boss tells him, I don't care, just go get me oranges. I have the feeling that in a month's time, the price of oranges will skyrocket. So go buy as much orange as you can. The guy goes into the market the first day and he finds that one orange goes for $1, right? So he buys up as much as he can in the market. Unfortunately, the supermarket he went to have only 1,000 oranges in stock. So he buys up everything at $1. He comes into the market the next day and discovers that the price of orange has now grown from one for $1 to one is for $2. Right? So let's say buying up this 1,000 costs an artificial scarcity. Right? So he discovers that one orange now goes for $2. And now he has the opportunity to buy, let's say, 500 oranges or 5,000 oranges, as the case may be. So what will he do? He still hasn't met his target. He still has $9,000 or thereabout, right? He will be thinking of buying up as much as possible of this 5,000 here at 200. So you notice that day one, price was at this level. Day two, price has gone up. And for us, looking at the chart, when price goes up, we say we are bullish. What I want you to note here is that this transaction here is one open interest, right? There was one buyer with one seller. This transaction here too is pitching one buyer with a seller. It doesn't mean that we have more buyers in the market. It simply means that the buyers are very aggressive and they will buy irrespective of the price, so long they feel the price is fair. If they feel the price is fair, they would buy, right? So that is the theory around open interest. It doesn't believe in buyers being more than sellers in the market, as it were, right? So back, let's come back to the screen. So seller is equals to buyer is equals to one open interest, right? One open interest. To the next slide now. All right, so let me take you to this page here. Well, I should do this. Let's come to this page. All right, I'll drop this link in our Telegram group for those of us who may want to explore this. Again, explore it, do your back test. Don't jump into trading live money with what you just heard on YouTube. I'm not a financial expert, neither am I a financial advisor. In fact, don't take anything I say seriously. All right, so this CME group website gives us data on open interest, and usually open interest comes 1 day late. It comes 1 day late. On this website, you can see trade date here. It gives us 5 days data, right? 5 days data, one at a time. This can be downloaded here in Excel. I'm still looking for someone who can help us do something that can collate this data for us automatically and keep it over a period of time in Excel, right? I saw someone doing that. Unfortunately, I can't track the person down. So, right, so this is Tuesday, the 15th. This data will only be available midway into the Asian session of Wednesday, September 16th. Right, so you won't get Tuesday have to happen. Then we'll get Tuesday's data on Wednesday, midway into the Asian session. All right, so Wednesday's data will be made available to us on Thursday. For instance, the latest data we have here is Monday, right? And that's this final data was made available midway into the Asian session. For those of us that are in West Africa, that was like early hours of this morning. We got yesterday's data. So it's usually 1 day behind. However, if you know how to interpret this, you could use this to determine if you should remain in your buy, resume a buy, get out of your trade, anticipate consolidation, and several other things you could do. Right? Remember, we use open interest to spot the footprints of the big guys in the market, right? So here, when you let's start from the last data we have, the earliest data we have, which is Tuesday, September the 15th, Tuesday, right? If you want to read the open interest, for now, based on our level of exposure for now, I want you to concentrate on just the features here. So you notice you have the Australian dollar futures, right? Futures, then here you have options. Now go down, you have the British pound futures right here, British pound futures. This is for GBP. Scroll down, you have the Canadian dollar. This is for CAD, and like that. So you face only the futures for the currencies. You have some other exotic pairs there that we might not be looking at. Then you have the euro, right? Basically, this is what you do. You face these ones. So let's move on. So when we look at open interest, we are, for now, for this webinar, we will be looking at the change, the very last column here, the change. And we'll be focusing on whether this change is positive or negative. So if it's positive, we say it is rising. If it is negative, we say it is falling. And for now, we may not bother about the size of the change. So if it is 2,383 here, we say it is positive. If it is only 30, we still say it is positive, right? For now, we just bothered about whether it is positive or negative. That is what we want to focus on, right? So let's take, somebody drop in the chat box, what currency feature would you want us to look at? So it doesn't look like we're cherry picking. We have the Canadian dollar, Aussie, New Zealand, Euro, not the USD anyway. Anyone? When we're looking at open interest, we're not looking at GU per se. Somebody say pounds. Okay, so let's look at the pounds, right? And Chris said CAD. Let's look at pounds, for instance. So we're going to spend some time with pounds, GBP. So here we have the pounds. The pounds will be a little bit tricky because of the Brexit issue happening, but never mind, we'll still look at it. So this is the British pound futures here. As at Wednesday, right? This is Tuesday, September the 15th. So on Wednesday, we would be looking at GBP here, and it will be negative. This will be negative, right? So what does this mean? It means some money is leaving the market, right? It means money is leaving the market. When you look at GBP, somebody is writing on my screen, I believe mistakenly. All right, it means money is leaving the market. Great British Pound futures is negative. Remember, when one buyer and one seller meet and they are paired together, we say the open interest has increased by 1. So if the open interest reduces by 770, it simply means some people took money off the table, right? At least with regards to the Great British Pound. It means some people took money off the table. So how do we interpret this? So we'll go into the interpretation, then we'll come back and look at some examples. So when price is going up and your open interest is also positive, remember we said positive means it is rising, it is a bullish sign, right? This is the very simple way of interpreting it. If you want to go a little bit deeper, you hear things like when the rate of rise of the open interest is faster than its 5-year seasonal average, this is a bullish sign. What this means is that more participants are entering the market, which is involving additional buying, and purchases are generally aggressive in nature. Remember we said that open interest tells us how aggressive buyers or sellers are, right? It doesn't see it like there are more buyers. So price is rising and people are still willing to buy. So you get things like that happening when we have risk-off moments where maybe something is happening and people are moving their funds to safe havens, or people prefer to cash out from other investments and save their money in gold, right? So you discover that gold kept rising during the Corona period and people kept buying. People kept buying and buying, and gold got to 2,000, right? And people kept buying. So when price is going up and open interest is at the same time being positive, or open interest is positive, is a sign that the trend is bullish. And if you're a swing trader, this will be a sign to hold on to your trades until you begin to see sign of weakness of trend or bearishness, right? So when price is going up, so we'll come to our chart. Let's look at GBP card, for instance. GBP card. So if we look at GBP card, and I'm doing this on the daily time frame since open interest comes once a day. So if price is bullish, like we have here, and my open interest is positive, is an indication that I should hold on to my bullish trades, right? If price is bullish and open interest is positive, it's telling me hold on to your bullish trend. That is the meaning of this. So price is going up, open interest is also rising, bullish sign. Again, if price is going up and open interest is negative, is falling, is a sign of bearishness. So rising prices and a decline in open interest at a rate greater than seasonal normal is bearish. this market condition develops because of a term we call short covering, not necessarily because of fundamental demand, right? And what is short covering? Let me read up the whole sentence, then we'll come back to short covering. This market condition developed because of short covering, not fundamental demand, is fueling the rising price trend. In these circumstances, money is flowing out of the market. Consequently, when the short covering has run its course, prices will decline. So let's see this. Price is going up, but open interest is falling. It simply means that the big guys, the commercials, are feeling that price will drop. When the commercials feel that price will drop, they will be cashing out. They'll be taking profits. And when they take profits, you will see it in open interest as a drop in open interest. What happens is that as they are cashing out, let me annotate again. Annotation makes this thing easier for us all. Let's use white here so we can see. So we've been having a bullish trend, right? All of a sudden, price keeps going up, but your open interest is coming down. It means that the commercials feel, and when I say the commercials, the big guys, they feel that price will soon drop. But you know, retail traders would have drawn their trend line and see bullishness. So the retail traders will be very, very convinced that price is bullish and they keep buying. But who are they buying from? They are buying from the commercials. The big guys are the ones selling to the retail traders in bits and in bits and in bits and in bits. And they, you know, they jam up so many retail traders buying at the same time. And what happens then? Price drops after a while. Price drops heavily. So when you see price rising and a decline in open interest, it shows bearishness, right? We should anticipate bearishness coming into the market. We'll do some examples, so no problem. Let's move on, right? All right, so the next one, when price is in a downtrend and there is a rise in open interest. When price is in a downtrend and open interest is positive, is a bearish sign. So let's make it easy for us all. When price is going up and open interest is going up, is positive, it means continue the uptrend. When price is coming down and open interest is still positive too, it means the downtrend should continue, right? You only have discrepancy where you have negatives in terms of open interest. So when price is pushing upwards, open interest is pushing upwards, continue your buy. When price is pushing downwards and open interest is still positive, it means continue your sell. It means if it is selling and the big guys feel it will continue to sell, so they are in the market. So if price is declining and open interest is rising, it indicates that new short positions are being opened. Price is dropping and open interest is increasing. Remember, open interest means that new buyers and new sellers are coming into the market. One buyer, one seller, positive open interest. So when price is declining and open interest is rising, it means new short positions are being opened by the commercials. And that means we should continue to sell. So as long as this process continues, it is a bearish factor, right? It is a bearish factor. So price is going down, open interest is increasing, meaning that new participants are coming into the market. And when we say participants, we're not talking about you and I, right? We're talking about the big guys. They are coming into the market. They are shorting that particular pair. No, this is not pivot point. This has nothing to do with pivot point, Mr. Festus, right? So price is coming down and open interest is positive. Again, if we come here and you open your Australian dollar futures and you see that it is positive, then you go to your chart and discover that you're in a downtrend. But the change in open interest is positive. Change means the difference between yesterday and today's data is positive. What this is telling you is that more sellers are coming into the market. And at this point, we're talking about the big guys. I mean, the big guys are supporting the sell. Then you and I should hold on to our sell if we're in one already, or simply get out of our buy if we're in a buy, or be thinking of looking for reasons to want to sell if we are not in the trade at all, right? So when price is, the next point now, when price is in a downtrend, which is the exact opposite of the first point, when price is in a downtrend and open interest is reducing, is negative, it means some people are getting out of the trade. Some people are closing their trades. Some people are closing their deals, right? A decline in both price and open interest indicates liquidation by discouraged traders with long positions, right? So the guys that have their fingers burnt are liquidating and getting out of the trade, right? So price is going down and open interest is also going down. As long as this trend continues, it is a bearish, it's supposed to be a bullish sign, right? So price is going down and open interest is falling, it is a bullish sign. It's supposed to be a bullish sign there. The error is mine, right? So let's begin to wrap up this, then we'll go into the chart. Again, I believe we said at the very beginning, if you are very new to trading, this will look like Greek to you, right? So now, what about instances where price is ranging? If price is ranging and open interest is rising, it's a bearish sign. It shows that the large guys are selling a lot in bits to retail traders because they think that price will drop. They will not sell if they think that price will rise. So if you're in a range, if we are in a range and price is ranging, however, while price is ranging, the open interest is rising. It simply means the big guys are not really moving price, but they are selling in bid because the retail traders think that price will rise. So the big guys are selling to them. And after a while, what will happen? Price is going to drop. So if you notice that you're in a range on a higher time frame, you want to watch out for your open interest to see what is price doing. So when the open interest is rising, it's a bearish sign. It shows that the large guys are selling a lot in bids to the retail because the retail think that price, because the retail guys think that price will go up. But the big guys have had enough and they are taking profits. Remember, before we get to this point, we would have been in an uptrend, right? When an uptrend, the commercial guys bought from this level and they've held their buy positions up to this point. All of a sudden, they are ranging, they are consolidating. And what they are doing at that point is that what they bought here at $2 and is presently at $10, they are selling it off. Why? The retail guys have seen that this is an uptrend. They've drawn their trend line, they've drawn their channel. They are very convinced that this is an uptrend and they believe that this is just consolidating for a buy, right? In fact, the consolidation, I should draw it properly, it will most likely look like this, right? It will look like a bearish flag consolidation, right? So the retail guys will be anticipating a buy and the commercials will eventually sell. So when we find consolidation at a higher time frame, we want to look at our open interest and see what is the open interest telling us? So when price is in a range, of course, the exact opposite, and open interest is falling, this is a bullish sign. Commercials are shorting and covering. Yes, I think I forgot to explain this short. So when open interest is in a range and price is falling, is a bullish sign. So price is the shorting here and covering is like they are taking partials, right? So let's say they bought from this point, from point A, right? And they've been able to move price to point D. They will take part of their profits, right? And when they take part of their profits, what does that mean? It means they will be selling. They will be selling to the retailers, right? And price will look like it's consolidating or even behave like it is dropping, only for them to resume the buy at a later date. So when price is in a range and open interest is falling, this is a bullish sign. Commercials are shorting and covering. So for a ranging market, it's best to look at the higher time frame. I think I've mentioned that in passing. Let's quickly read this. Right, so a breakout from a trading range will be much, much stronger if open interest rises during the consolidation. Right, exactly what we explained here. This is because many traders will be caught on the wrong side of the market when the breakout finally takes place. When price moves out of a trading range, these traders are forced to abandon their positions. It is possible to take this rule one step further and say the greater the rise in open interest during the consolidation, the greater the potential for subsequent moves, right? So you want to really go play around open interest. Like I said, I'll show you some examples and how to go about that. So finally, we're in the last slide. So when you get to a support, price is trading upwards, and you get to a support somewhere here, supporting price to rise, and you notice the drop in open interest, at that point, you should anticipate bullishness, right? When you get to a support, I believe we still remember our support and resistance. So the support is usually down, the resistance is usually up. So we have support here and we have resistance. If price is at a support, and at that time you notice a drop in open interest, it means you should anticipate a rally. A drop in open interest, anticipate a rally. At a resistance or a premium array, and you have a rise in open interest, it means we should also be bullish, right? I will drop these slides again in the Telegram group. If you are there, if you are not on our Telegram group, you could just join. And if you're joining much more later, in case we post this on YouTube, you can always find it in the files section. So let's quickly go back to our charts and see how we can use this. Somebody saying COT data, other pairs are against USD. Is it the same here? Yes, you could use it. Like, so we would have another webinar on commitment of traders, right? And how to use them. If you follow Michael, he uses open interest. He does a lot of commitment of traders too, right? So let's quickly wrap this webinar up. Now we're looking at GBP futures, and we're here on Tuesday, right? When we come to trading view, let's have a vertical line somewhere here. Right, great. So we have Tuesday. Where are you? Oh, great. So we have Tuesday on GBP, Great British Pound. Tuesday is negative, right? Tuesday 15th is negative. So here we have Tuesday the 15th. We will be seeing this information on the 16th. we will be seeing this Tuesday's information on the 16th, right? And we notice that it is negative, telling us that this bullishness that we are observing is coming to an end. That's what it means. It is positive. Yeah, the price is pushing upwards, but open interest is negative. What do we see happen in that instance? When price is moving up, price is going up, open interest is negative, which is falling, is telling you that the market will soon be what? Bearish. And what happened? The market fell the next day. Right? The market fell the next day. So if you're in our fostering class, you will be looking on this day, you would be anticipating a divergence upon the take of the previous day's high, divergence using our OSMA, and that will, indicate willingness to want to drop, and then you sell. Again, remember, nothing in Forex is cast in stones. If it were, like we always say, we will all own an island in the Bahamas, right? But it is to guide. So the open it was a bullish market, and the open interest suddenly reduced. It dropped. When that happened, it's telling us that there's every likelihood that that bullish trend is getting to a point where it will change. It means money is leaving the market, right? So let's go check out the next day, Wednesday. So check out Wednesday. We'll check out Wednesday on GBP. All right, so here we are, Great British Pound futures on Wednesday, right? Remember, Wednesday will come up when? We'll be seeing Wednesday on Thursday. This is Wednesday the 16th, right? So let's go back to our chart again. Here we are on the 16th. Wednesday the 16th data will be showing up on Thursday the 17th. Notice how massive the bullish candle is, or rather was, the previous day. But what was open interest telling us? Open interest is telling us that, hey, be careful, guys are cashing out. Guys are cashing out. The big guys are cashing out. They are selling to the retail traders. Why? The retail traders are seeing these 3 days rise as what? Sign of bullishness, right? If you go to the lower time frame, in fact, you don't need to go to the lower time frame. If you understand the candlestick anatomy, what you would see here, what this shows you, is basically a rise, a drop, a rise, a drop, a rise, and what we'll be anticipating, a drop, a rise, right? So they've painted a scenario of a bullish trend for even trend line traders on a lower time frame, right? So if you go down to a lower time frame like 1 hour, and we bring this all the way to the September the 14th and go to 1 hour, clear this up. So if we go to September the 14th, right, you clearly see an uptrend forming, right? You clearly see an uptrend forming. So irrespective of what you use, BTMM, you would have seen a peak formation low, level 1 rise, level 1 consolidation, blah, blah, blah. Again, remember we said use what you are comfortable with. But could open interest have told us that we will be having a reset at this level, right? If you trade BTMM, you will discover that what happened here was a reset, right? We seem to have a reset here, and price seems to be pushing downwards. So could open interest have informed us of that tendency for a retest, remember we spotted on the daily, we spotted that willingness to make a U-turn in his bullishness. We spotted that all the way from Tuesday, right? We spotted it on Tuesday. So Tuesday was bullish, but we had a negative open interest, telling us that there's a tendency that it might soon drop. But that doesn't mean get out of your trade instantly. We still have to trade price action. We still have to trade price action whether we choose to use order block, source, breakout, whatever we're used to. We still have to trade price action. But how can we predict things or forecast things even much more easier or with some level of precision? And that's where open interest comes. So open interest told us it was negative. Then on this particular day where we saw bullishness, open interest told us that it is even more negative, right? You remember we saw that. We saw bearishness, right? We saw bearishness on Wednesday. So on Thursday, again, let's see what happened on Thursday. So Thursday the 17th, which would be Thursday the 17th, right? We will be having this information on Friday. So what does it tell us? On Friday, sell. Now, why? The open interest is turning back positive, right? The open interest again turned back positive on this day, right? So it has picked up. It has peaked at the top and is now coming down. So let's go back again to finally Friday. Let's see what happened on Friday. Open interest September the 18th. We expect it to be positive, British pound positive, and that supported the drop even further, right? So long as positive, even if you have a pullback, if you're a swing trader, you are encouraged to still hold on to your trade or some fraction of your trade because the tendency to still drop even further. And today, we can see this drop of about 180 pips of GBP. Let's see what informed that again, or how could have interpreted that. So let's see Monday's data. So what is Monday telling us? Monday data for GBP is still positive. It means we are still going downwards. I don't know if this makes sense to anyone. Yes, it is more effective for swings. Remember, you only look at this on daily time frame, right? You only look at this on the daily time frame. It tells you what you need to do. But if you're a scalper, for instance, or you're somebody who trades the beat the market maker method and you're waiting for price to trade again to take out the Asian low or give you a type 1M, type 1W and the likes, besides your EMA crossing, right, what are the big banks doing? Are they planning to make a reset? Could we have known that a reset is coming? This is GBP card. Can I, unfortunately, I don't have any MT4 open. Let's see if I can quickly open one MT4. Let's see if I can quickly open one MT4 and we'll go in and see how we might have been able to interpret GBP card. So, you know, the idea is this. If Michael usually say that Michael will predict, I'm talking about Michael of ICT, he will tell us where price will get to, sometimes to the peep. And then he will come back and say, I know some of you will tell me that if I know price was going to get to this level, why did I close out my trade? And if you follow Michael, you will know that Michael, I don't know if I'm to call him a short-term trader or a scalper. Right? The guy trades even the 5 minutes time frame. And sometimes price just goes 15 pips and he's taking profits. Right? And you see we retail guys that we are very happy to show that price went 1 million pips in our favor, even if it's a demo account. right? So when you see open interest, it's only telling you the price might do this. Then you begin to look for your pattern within price action to determine what you want to do. And somebody just picked up GBP, and we're looking at GBP card. So let's see if MT4 comes up and we see how we could have traded GBP card. All right, so let's see how we could have traded GBP card. What's happening to my MT4 now? Prof, speak to this thing, let it come up. What's
where you don't overload and money.
My brother, it can be very frustrating sometimes when you see price moving and you know that for every pip here is money, and the only thing you need to do is correctly interpret these white and black candles and you'll be rich, and you still struggle to do it. It could be frustrating sometimes, you know.
Yeah.
So let's look at it. So we had reasons to go. We're precisely looking at this date here. We're looking at 17th and 16th. 17 and 16. We started seeing signs on the 15th, which we would have seen on the 16th. We started seeing signs that the big guys were taking off money from the table. We started seeing that sign, right? So when we see this, but price still pushed upwards, fine, we'll stay in there. Even on this day, price tend to have pushed upward a little, but the big guys were taking money off massively. So 16th to 17th, what do we see? So from 16th to 17th, let me take off the fractals for now. It was Prof that brought me back to fractals. So you notice that on this day, we had already seen signs of they taking off profits on this day. They were taking off profits. On this day, they took even more profits, right? Notice what happened. Price pushed higher, and this pushed even lower, right? That is the way we read our divergence in the first string class, right? This was reason what ICT traders would call a turtle soup, right? This was enough reason to go short, right? And of course, from that point down to this point, price has dropped 230 something pips, right? So that's how we interpret it. So once you see a negative open interest in a bullish trend, you begin to anticipate bearishness. That doesn't mean you should take off your trade instantly, right? You may want to go down to the H4 and see if we're trading into a previous source, or indeed if we're trading into an order block. And if you're trading into an order block for a drop, that might be a reason to want to take your trade down. So whether it is order block, institutional order flow, BTMM, if we call up the BTMM template here, we call up the BTMM template here on GPP card on the 1 hour, GPP card 1 hour on that day. So we've had our drop, we have our peak formation low, right? Remember how we usually read it. Price will have to break this level for us to have level 1 by using price action. However, by using moving average, level 1 was locked here, right? Notice how price traded straight up to what we would call our level 1 using price action, right? We had a webinar. When price got to that point, they began to take some profits off the market and price dropped thereafter, right? That is how we read open interest. I wouldn't want to take so much of our time about 50 minutes now in this webinar. If it's clear enough, I'll post it on YouTube. If it's not, I'll just post a link to it on SimplyPips, and we can go have a view. I'll also drop this again. At first glance, it will look a little bit confusing, but you just need to know that what you're looking out for is positive or negative open interest. If the open interest is positive and price is going up, keep buying. If the open interest is negative and price is going up, start anticipating that price will change. It simply means people, the big guys, are taking off money. However, this law changes when you get to a ranging market. When price is ranging, and I prefer to do this in the higher time frame. Unfortunately, except we have somebody that can help us find a way of correlating this data automatically, I would have wanted us to see what price did. Unfortunately, I didn't keep a record of that. On Euro AUD, what price did on Euro AUD H4 during this consolidation, right? During this consolidation, when price was consolidating, what do we want to see? So if price was consolidating, and at that same time we are noticing an increase in the open interest, it's telling us we should be ready for sales. For price to be consolidating, it simply means that they have first created a false impression of a bullish trend, and retail traders are believing that price will continue to push up, and these guys don't want price to push further. So for every push up, they're actually selling to some guys who are buying, then they come back, then they sell again to some people, and price goes up, and finally a massive push. And the last stuff they said, when you notice that there is consolidation and there's a massive increase in open interest, it means that the push out of that consolidation is going to be massive. Notice the number of pips moved within 1 week, right, on EA. It was basically about 300 and something pips, right? Whereas 3 weeks before then, it was barely doing half of that, right? So ladies and gentlemen, let's call it a close here, except someone has anything to add. I want to state here that we've had a lot of people coming to our DMs, I am Prof, requesting for the 4th string class. We wanted to make it next year, but we are now beginning to consider maybe the 2nd week in November. We'll drop details again in the Telegram group. There's a possibility we might have new entrants in the 2nd week of November, and that simply means your Christmas will be short, right? Because you have a lot of work to do. Prof, any information for us as we wrap up?
Nothing. Just what you did.
All right, so let's see, quickly take a roll call. I can see so many Emmanuel here, I can't even differentiate them now. All right, so let's go to the Telegram group and ask our questions, make the noise there. Nice having you guys around. Have a very, very wonderful night rest and take care.